Welcome to Breaking Banks, the #1 global fintech radio show and podcast.
Well, there is no doubt that the coronavirus pandemic has had a huge impact on our daily lives, and in ways that we still don't know. We don't know what's a temporary change and what may be longer lasting, but we do know that, like everything else in our lives, all aspects of banking have been becoming more digital and more mobile for well over a decade now. Customers of all types and all ages are increasingly comfortable using digital technology, and the pandemic forced most of the stragglers to finally cross the Rubicon. Straggling bankers crossed along with them, and they were forced to serve customers in new ways, with many pleasantly surprised by the results of, let's say, their improvised efforts. Today, Jason and I are joined by regular contributor Ron Shevlin, who's Director of Research at Cornerstone Advisors and Senior Contributor at Forbes with his Fintech Snark Tank column, along with Mary Wisniewski, Banking Editor and Fintech Features Reporter at Bankrate.com. We'll talk about how customers' preferences and needs are changing, how the digital landscape is shifting, and what financial institutions need to do to win in this rapidly changing world. Ron, I'll start with you. You wrote an article recently about the new Google checking account. How does that change the landscape? And maybe we should just start with, what the hell is a Google checking account anyway?
Well, it's your guess is as good as mine, and really good as anybody else's. So,
including their bank partners.
Yeah, well, and in particular, their bank partners. Quick history: the Google checking account was really first kind of leaked or announced back last November when they said they were going to come out with a checking account in 2020, and two of the partners were Citibank and Stanford Federal Credit Union. Hadn't heard much in between until about a week ago when they announced 6 new partners, including a credit union, SEFCU, State Employees Federal Credit Union in Albany, New York, a couple of relatively small community banks, one of them being Coastal out, at least closer to UJP in the Washington area.
Yep.
And a couple of relatively big banks, BMO Harris and one more in there whom I'm blanking out on, and Bank Mobile as well. So I reached out to 4 out of the 6 partners, and they responded to me, and I asked, well, what is a Google checking account? What are they telling you it is? Have you seen demos and screenshots of it? And if not, what are they telling you is going to be in it? And I've got to tell you that it was like they were all reading from the same script. Every single one of them said, we can't share anything at this point. You get the typical blah, 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 why we can't say anything. Personally, I think they're not saying anything because they don't know. I think they're kind of going on this and on a leap of faith. That said, I'll put my stake in the ground and tell you what I think it's going to be. I think it's going to have a real Apple Card-like online digital application. I think it'll be real smooth and easy. I think, due to who Google is and what they've got, they'll be able to do things like KYC and things like that pretty easily. I think we're going to see a lot of PFM tools. I think they'll be pretty slick, but I think, one of the things I think would be a bit of an advantage will be more, contextual real-time offers versus, PFM type stuff. And, I think the real promise is that, if they're really good at this, it can really transform the banking experience, by really integrating it into the browsers, into Chrome, into search. Can you imagine, searching for a Google checking account and then just clicking on the open button and boom, it's there. So, I think there's a lot of opportunity and promise for it, but what it exactly is, nobody knows or nobody is saying, and I think it's the former.
Well, Mary, how much has this shown up on your radar screen yet? You're very active in researching products and banks and consumers' reaction to it, and it's still pretty early because it's not out there. The partners don't even know yet, but what's your reaction so far from what you've heard?
It's interesting. I mean, I don't want to repeat Ron's point of view, but it's, everything's so nebulous. It's like, what exactly is this? So consumers, I haven't been hearing anything, but also haven't been doing that query of like, do you want this bank account from Google? I do think an area that could be interesting if there's any way to improve the way someone signs up for an account. I think that's still big time challenge, let's put it delicately. Anything with PFM, I mean, Google's such a data player. I mean, if there's an interesting experience there that might help people in their daily financial lives, that would be promising. But yeah, at this point, who knows what this is?
So not to be the counter narrative, but I've been catching up on my snark. I'm trying to out-snark Ron Shevlin these days.
Good luck with that.
I think it's okay that they don't know what it is. And I think it's going to fundamentally look different than the typical bank account that we're seeing because they're so good at embedding experiences. And I think the fact that they're not committing to something so that they can actually roll it out, play with it, see what people use, roll features back in, roll features back out. Look how long Gmail was in beta so that we weren't locked into the expectation of what it was. Well, they figured out the true feature set. And I think that's the most exciting part about Google and what they're doing here. And I'm just proud of the banks that were willing to commit to something without knowing exactly what it was going to go look like. That's very unbank-like behavior in their regard. And I think it's going to be great for consumers as a result.
But Jason, were you surprised that they went with multiple bank partners as opposed to going direct to consumer or with a bank partner kind of in the background as an issuer?
I was surprised at the breadth of the bank partners they went with. It was not a cookie cutter set. They have some big, they have some small, they have some known for being innovative. They have some that frankly aren't known for being so innovative. And I think having multiple players gives them a lot of latitude in the things they want to do. And there will be some of the bank players that are willing to commit to one thing and others are not going to be able to get there. And I think it was very smart of them to have several and do it simultaneously.
Of course, it's easy to assume that this is all just a big data play for Google. They already have so many pieces of data. Now this gives them a whole other level of transactional and financial data that they presumably don't already have. Although, Ron, you also mentioned that as you look at who might be signing up for this card, it's highly correlated to people who are already using Google Play.
Yeah, I think it's important to understand the demographics, and it was just interesting timing. I hadn't really planned on this, but I had just conducted a consumer survey at the beginning of July and asked consumers about a range of non-financial providers. I asked about Amazon and Apple and said, if these firms were to come out with a checking account, what would you be likely to do? And I didn't just ask, would you open it or not? I asked, would you open it and close out your primary account, or would you open it and put some money in, make it a secondary account? And so, number one, there's broad interest. There was about a quarter of consumers who said that they would have some degree of interest in opening this account. Majority of them being more focused on making it their secondary account versus their primary account. But when looking at the details of these consumers, one thing really sticks out. These are existing Google Pay customers. These are people who are, making frequent, at least once a week, if not once a month, use of Google Pay. And I think that's where the account actually will be, displayed or demonstrated or, manifested, is within the Google Pay app itself. So, you got to think about this from the perspective of, the last numbers I saw said that Android devices in the U.S. have about 40% market share. So you're already, cutting out 60% of the market. The percent of Google Pay users are, relatively small in perspective to that. So, the real initial market for this is really kind of small when you really think about it. So, Jason, I agree with you that, I actually do congratulate and support the early partners for kind of, making the leap of faith. But I think the real impact they're going to see is really going to be quite limited in at least the first year or two.
Mary, what's your sense of that? You've got your finger very much on the pulse of the banking consumer.
I mean, I guess they would need a hook. And so from my perspective, usually it's like this pool of people is picking this product for this specific need. For example, you see some of the challenger banks, people are signing up to be able to get their payday early, even though some credit unions also offer that feature. So it's like, that's the kind of hook. So what would that be with Google? I mean, clearly it would be broader, but it would need to be something beyond, hey, here's this, here's this checking account. I mean, frankly, like, what is even a checking account? I'm sure you guys talk about this all the time. Like, it's a silly name at this point in time.
And I think that's the point, Mary. I want to go ahead. Getting your check a little bit early is a stupid hook. Like the fact that that is what challenger banks came up with, whoop-de-doo. Like banking should have fixed that long ago. And right, like it's like the fact that that even is even a hook is just crazy.
But it is. It totally is.
But it is, right? Unfortunately, I think Google's got bigger aspirations than that.
Hey, Jason, just quickly to that, going back to the survey, one of the things I think is really important for people to understand is that, the longer term trend in the change in consumer behaviors. For us old people, and I mean, I won't even put a number on it, but, for us old guys, it used to be you had a checking account. That was it. And if you had a second one, it was probably because, you opened up some account and you had to get the checking account in order to get the discount or the bonus or whatever. And it was something that just sat there. And this is very different now. Many consumers, more than a third, it was about 35%, if I remember the number correctly, have 2 or more checking accounts, and they are actively managing it. There are reasons why they open up that second bank account. A lot of it is for better interest rates, better PFM tools, debit card rewards, things like that. But in looking at the consumers who have now made a digital bank their primary bank, first of all, it's still a relatively small number, only about 6%. But number one, many have a secondary account with those digital banks. And among those that do consider the digital bank their primary bank, many of them are actually Chime customers. And for them, it was the early access to the paycheck that was one of the primary reasons for them selecting it. So yes, it's kind of a dumb reason. And, as I talk to a lot of bankers, they don't care about that so much. But it may be something that they kind of have to turn on at some point in the near future.
Well, I want to continue exactly down that path, Ron, and talk more broadly about digital banking and features and customer impact and all that. But I want to stay on Google for just one second, because you referenced the Apple Card earlier, and you just talked about Google Pay. And as if we didn't have enough ways to, further divide ourselves as a society, are we going to end up being, are you an Apple banker or an Android banker? Is this where this is ultimately going? Or do you think this will go, either or both of them will go cross-platform?
I think if history repeats itself. And if you go back, I don't know, was it 40 years ago, if you remember when ATMs first started coming on the market, you could not just go to any ATM. You had to go to the ATM for your bank. But over time, alliances, systems were integrated. So at some point, I can't see a Android Apple split persisting. It's just not going to be feasible to kind of bank that way. So, we may have some problems in the early phases of adoption, but I think long term that those differences will have to be overcome through integration.
Yeah, I'm sorry to say that I'm old enough to remember actually carrying a paper guidebook in my glove compartment for when I traveled out of town or out of state, so that I knew which ATMs I could go to. And by the way, kids, this wasn't about how do I save, 50 cents or $1.75 or whatever it was. It was like I literally couldn't get access to it, and it's hard to fathom today.
JP, how big was that book?
It was a good, 80 pages. It was a little brochure, like folded up the size of a street map, but a good 20 times thicker. And it was listed state by state, city by city. And I remember my best friend from college lived in New York City, and remember, of course, everything's so expensive in Manhattan for this Ohio boy. And, I have to, we're in Midtown. I have to go somewhere on the Upper East Side to find an ATM so I can get out another $20 to survive the day.
Gosh.
Yeah. Despite there being differences in the platforms, let's keep in mind the Chrome desktop does have close to 70% market share. And if you think of, mobile first, it has been the rage for a while. And our friend Jim Maroos, likes to talk about the voice first revolution, but so much still happens on our desktop or on a tablet, which is actually very different than mobile, or we have Chrome loaded onto our phones itself, that I think part of the play here with Google is embedding those financial services into the places we're doing things. And where are we doing things these days? Well, we're doing it on the internet, whether we're home or not. We're doing it in the browser. And so I don't know that they even need to have a big presence of standalone apps for them to get work done.
Yeah, that's exactly what I was saying earlier in terms of where the potential for real change could be, is if this is really integrated into the search experience, integrated into the browser itself. And, that could really be one of the big revolutionary changes that this could bring about that we haven't seen in a long time.
Yeah, I mean, we hear a bunch of banks talking about things like geofencing, and the use case that always comes up is, if we only knew when they were on, the lot to buy a car, we could, offer them a car loan right then. Guess what? By the time they're on the lot, it's probably too late. You want to catch them, when they're on Kelly's Blue Book, looking at their trade-in value or beginning to do some of those things. And I think, Ron, to your point, that's where the power is going to come in. And as much as we've seen backlash from, some people online saying, I don't trust Google with my data. Well, guess what? If they're doing something with my data that is adding value to my life, have the data. It's really, the problem is when they're using the data, they're not adding value, and they're serving me ads that are not relevant. I'd rather actually see ads that are relevant to me, and I'm willing to actually expose more of my financial life if it's going to help me.
Well, just a quick note on the cross-platform stuff, is since we're cataloging JP's quirky things here. I once did a Siri search on my Apple Watch to look something up, and for whatever reason it came up on Chrome, because that's my preference on my desktop. And I cannot, every time I open Chrome now, it shows a new window for me to open with the Apple Watch icon. I cannot figure out a way to close it. Nothing to do with the banking thing, but I hope we can figure that out. I want to stay with one more thing on the Google thing. Ron, you said that, at the end of the day, this is maybe a bigger threat to tech vendors like FIS and Fiserv. And for the banks that are partnering with them, is this like partnering with Amazon? Are they doing a deal with the devil?
Maybe, and here's why. I think, first of all, I have written about this and becoming a firm believer that both Amazon and Google are looking to become more vendors to financial services companies than competitors to them. Clearly, the partnering the checking account is one example of that, but you've also got Google coming to market with these AI lending tools. They were specific to the PPP loans. You also, of course, have both Google and Amazon, who are huge providers of cloud services. So, these firms are just as much, vendors to the banks as they are competitors. I also think that, they bring something to the table that, sorry guys at FIS and Fiserv and Jack Henry, they bring something that those firms can't bring, which is market opportunity. They have both sides of the coin. They can bring the technology to the table as a service provider, but they can also say, we can help you get customers. It's funny, the vendors have always claimed, the ROI that their banks and clients, get when they go out and use their technology, but they have never really helped on the market side of it. And that's something that both an Amazon and a Google and even an Apple can promise. And so I think that's, makes this a very, appealing proposition. The point, just quickly, about the selling the soul to the devil, is really about, I kind of look back at this and say, well, if Google is doing everything from a checking account perspective, what's the bank bringing to the table other than the banking license? And, as I joked in the article, I said, so I can hear a bunch of bankers go, well, it's our great customer service and our knowledge of the local market. And as I joked in the article, I hope they can't hear me laughing about that, because it's just like, this doesn't, they don't know nearly as much as a Google or an Apple or an Amazon know about both the local market as well as the broader market. So that was what the point about the selling the soul to the devil is. What's the role of the bank then, other than a license?
Well, and I think that opens up even a broader question, and this is a good time to move off specifically from Google and just talk about digital banking more broadly. I mean, it feels very deja vu to me here in the middle of 2020 that we're talking about all of these new digital banks that are coming up. I thought we already had most of these conversations 10 years ago about business model and customer acquisition and all of those same kinds of things. I mean, we are kind of seeing a resurgence, and I'm curious, Mary, I'll again ask you to reply on this first, because you've been talking to a lot of consumers, as you have as well, Ron. I know, Mary, I was reading a report you did in late December, and not only does that feel like a few years ago, but that some of the data in that report really felt like a long time ago, citing things like branch location is number one choice of choosing a bank and all of that. What can we say so far about the way consumer trends are changing, and what does that mean to have a viability to really just be a digital bank?
Yeah, so pre-pandemic, you were seeing a lot of consumers still saying they want that branch, they want that ATM nearby, and maybe they're not even using it. It's just kind of like a safety belt type of situation. But that's been, that's thrown out of the window. I mean, branches were closed, and the challenger banks were seeing customer growth. Well, some of them, at least Varo was. I believe Chime hit a milestone when it was advancing stimulus funds in terms of how many checking accounts had signed up in a couple of days. So you see this acceleration of customers joining a bank via an online channel, but what will stick? I don't know. I mean, there's still so many poor experiences in trying to sign up for a bank online. I'm sure a lot of people are finding out it's not so easy to bank online at some at some institutions, and it could be a very frustrating experience. I know, like, call center lines are really backed up still. So when we come through the other side of this, will people care about a branch? I feel like there's still going to be a little bit of a portion of humans who actually do. Again, like, I don't know what that really is, but it seems present. But again, we're in this crazy time period, and who knows what sticks and what doesn't. We're all forced into behaviors we might not have done otherwise.
Well, go ahead, Jason.
There's this guy, Ron Shevlin, oftentimes talks about and shows data, whatever data is from actual research, that shows customers prefer going into the branch. And then he always asks the question is, well, would they prefer going into the branch to do their business there if you actually made it easy and convenient for them to do it without going into the branch, right? That's a misleading stat that the banks like to anchor on. Goes, see, look at our customers like going into the branch. Yeah, because you made me, for my convenience, come into the branch because there were 27 hoops to jump through to send a wire online. And now that the banks have been forced to rethink how they're delivering some of this, to Mary's point, I think the role of the branch has to change.
Yeah, I remember last year I wish I could remember the company. It was a startup, but they were even being like, hey, we want a branch, but to make it more like a WeWork space, rethink branch that way. But it was catered to small businesses, so that would make a little bit more sense.
Well, and Ron, do you drill down a little bit more on what you were talking about before on the preferences for the people that have a digital bank as a secondary bank versus those that have it as a primary bank? And I want to ask the question, does that even mean what we thought it used to mean? I think what we knew it used to mean, but is that still true, this idea that, we have a primary financial institution and all kinds of benefits accrue to us if customers name us as the primary institution? Or are we totally in the disaggregated world at this point, and there really is no such thing as primary?
I think it's both sides of the coin, JP, and let me try to explain. I think we're in the transition to that disaggregated world. There's still the idea of the primary institution, but to the idea that the old idea that the bankers have, that it's the anchor product, it's the thing that we need to get to build the relationships, I think that's very much out the window. Although there are plenty of consumers who have multiple products with their primary institutions still, but that's why I think we're in the transition. When I asked consumers who had secondary accounts why they did, I think one of the things that's important are the reasons that they did not cite. They did not cite that they wanted a secondary bank. In many cases, it was a digital bank because it was a digital bank. It's not the digital channel that they're going for. They're going for some reason to fill some hole or gap in their financial needs in their lives. And that could be, like I said, they want better tools to help them manage their financial lives, or they simply want better interest rates. That's why they open up a Marcus savings account to get better rates, or they want debit rewards on their rewards on their debit card, which many banks discontinued post Durbin. So they're looking for something in particular, and it doesn't even have to be financial related. Some of them say, I'm just looking for an institution that in which my values are aligned with, and that was a reason for why a lot of consumers open up an account with like an aspiration. They want that sort of alignment. So the reasons are kind of all over the map, for that. But I think it's important to recognize it's not because they want to do bank with a digital bank, and it's not because they don't like their current bank. It's to fill some sort of need. And because of the easy movement of money, why not? It's easy for them to do so.
So just before the break, Ron made the point that people didn't choose these digital banks because they wanted a digital bank. They were solving for some other problem. It's time for bankers to pull their head out of their branches, because they don't go to the branch because they want to. Yeah, you like that? I just came up with that.
I wasn't sure where you were going with that one.
I like it.
All right.
You got my endorsement.
You got my endorsement. But if they actually get out of this branch-centric and frankly ego-centric view that people think they want a checking account, or the story I like to tell is, the mortgage. No one wakes up in the morning and says, I want a mortgage. They moved, or they had a kid, or the kids went off to college, right? That's the story arc. The mortgage is just part of the story. And if we think about this world in this branch-centric, the accounts we offer centric world, we're going to miss it. And now to equally pick on the fintechs, just because you wear hoodies and you have a better digital lipstick on the pig, it's not enough. Like, we need to rebuild how we're thinking about financial services.
One thing that I would love to get bankers to realize and understand is it's not about the branch. It's about access to people. That's what consumers want. They have a question that they can't get answered somewhere else, and there are people in the branch who they can talk to, and the only way for them to get to those people is to go to the branch. It is not an affinity for the branch itself. And now we're in 2020, and look at us all sitting here on Zoom talking to each other. We did not need to be in the same room to do this. There are better ways to give consumers access to people that work in your organization than having branches. And that's one thing I would really wish that bankers would start to really understand, that it's not about the branch itself. Mary, I think you wanted to jump in there.
Yeah, that made me think of like Umpqua Banks, to their app that lets you text with bankers. That's been getting a lot of traction, and that it just highlights your point more. But two things I wanted to say. I think for some of the challenger banks, in addition to people wanting to solve another problem, and that's why they have multiple checking accounts or something, it's like referrals are allegedly big with these newer brands. So like, my friend likes this, so maybe I'm signing up. How true is that? I don't know. But the one thing I wanted to ask you guys is, usually people are also signing up for accounts because there's a milestone. You move, you get married, and now everything's kind of on pause. Are you guys seeing like direct ripple effects from that, or what do you think about like milestones are on pause? So what's the ripple effects on like checking accounts or digital banking products in other ways?
Ripple effect, or are you referring to like triggers that get people to?
Triggers.
Yeah. So I'll go back to the research because I asked a lot about that, and they're responding to offers, plain old advertising. There's an offer that comes up, they see it, they open up that account. I actually did not find that many consumers said that they were opening accounts because of referrals from friends or family, but they were doing so a lot in reaction to monetary offers. So those offers that Chase and the big banks throw out there, they do it for a reason, because people are opening up those accounts.
Yeah, that's pretty good bonuses right now. I think you can still find $400 from like Wells Fargo, for example, to sign up.
Well, and not to keep treading back to Google, but this is where I think they have a chance to fundamentally change the game, is they can give value that you can't find in other places. It's why, in my view, the Apple Card is so significant, that Apple has a chance to redo rewards and payments in a way that no one else can, right? What makes a great rewards program? It is high perceived or actual value to the consumer and low cost to deliver on the other side, right? It's that arbitrage opportunity. It's why is travel such an important reward? Well, the points are aspirational. I have a high value even if I'm not using them. The actual cost of that seat is I've more than paid for that flight to the Caribbean when we can fly again, in interchange and other before I actually redeem it, and with some restrictions and other. And I think this is where the idea of winning by offers should and needs to go away. And the idea of winning by, it's easy to open an account. I mean, not to pick on the neobanks that say that, it's like, that's not a winning proposition. That's going to become table stakes.
Well, and let's talk about that. I want to talk about, winning the game versus staying in the game, or, getting shut out of the game. And you all kind of brought this up in a slightly different way. So the one thing for the banks, I have argued for a long time, for the vast majority of banks, if you're not one of the ones that we've already mentioned or a handful of others, you likely cannot win the digital banking arms race. Right? You can't ignore it. You need to understand how to stay in the game and not get shut out. But you probably can't win at that. So let's start back to the neobanks again, because that goes back to my earlier deja vu comments. It kind of feels like, hey, we're digital and that's how we're going to win. And I'm seeing, more funding rounds and some high valuations on, no question that, again, the world's become more digital and more mobile, but I still have tons of questions on the business model, outside of low customer acquisition costs. So, I mean, what does it take to win as a neobank, first of all? And Jason, being a neobank founder yourself, I'll ask you first.
Well, I do think part of it is value in thinking about the business model, right? So when we launched Perk Street, the idea was 2008, debit was the fastest growing payment source. And there were nominal, if any, rewards that were being applied to it by the banks, because the banks actually didn't want you as a debit customer. They wanted to get you into a credit product, as BFA famously did when they introduced, they're going to charge you $5 a month to have a debit card, unless you also had a credit product with them. And the idea being, hey, we can, by being online only and partnering with merchants and being really good with our data, we can give people 1% back on their debit card purchases. That was real value, right? On average, we were seeing customers getting $600 in cash back for spending on their debit card. And the reason they used a debit card was, even though it's the same shape of plastic issued by the same banks, carrying the same bug of Visa and MasterCard, the behavior is very different, right? That's where your checks and your cash-based spenders were moving to, because they had better control of their finances. When we think of neobanks today, Chris Skinner and I talked about this in an episode last year, and sadly, we're not that much further along, is we've just seen some incremental improvements in what being a challenger bank is and the value it provides. So yeah, easy access, as Mary said, 2 days early. That's good. New kinds of PFM tools, interesting, but you have to teach me how to make that more valuable. And I think there is actually still room for winners within neobanks, whether those are the neobanks being launched by incumbents or tech companies providing bank-like services. But they really need to get into the mind of the customer and say, how do we really add value to you?
Well, one of the things I think, to bring it back to that early payday and why that is a hook, is just, well, this is not a good thing necessarily, but it's like that moment of desperation. Because one thing that's coming up with a lot of our readers are like, is this online bank safe? Is my money insured? And they're talking about like established players, let alone this name you don't know of, right? So I think, just like you're in a cash crunch, so you're gonna boogie in any way you can. But onboarding, I think just making it more simple in any way, I do still see that as competitive. Sometimes we test opening an account at some, different banks, and it's shocking sometimes. Like, it's an online bank, and yet it is still really cumbersome to sign up. And I'm like a person who has like a normal salary. I've lived in the same place for the same time, so I shouldn't be like red flag necessarily through know your customer. So I still think you can compete that way.
But isn't that just hygiene, though, Mary? Right? How much greater can I get that there's a lot of pain points, and it's shocking how many of them haven't been eliminated yet, especially by digital-only companies.
Yeah.
But is there a way to go over the top and oh my gosh, I have to have this new account because it's so darn good?
I think it's kind of funny, right? Because I'm thinking of my friend circle. Would they ever be like, "Ooh, baby, give me that bank account"? Crazier things have happened.
I loved shopping at the Amazon Go store the first couple of times with a cashless checkout, but I don't go out of there isn't one, walkable in my neighborhood. So I don't go out of my way to go there because the checkout is so convenient.
No, you need something that solves your problem, or someone that's hyping it to you that makes it seem like it can solve your problem. There needs to be something like that, I think.
So a couple of thoughts, JP, on this. First of all, I think Jason really kind of nailed it. And Jason, if Perk Street had come out 8 years later, it would still be in business and would be one of the big neobanks today. It was just too far ahead of its time. But your comment, Jason, about the adding value, I think that's actually spot on. But I think that the key, JP, to your question about how do they win, is in identifying the specific segments of the market where they're going to add value. The big banks have got the mass market, the undifferentiated market, kind of locked up. And if maybe not locked up, they certainly have a dominating share, especially of the millennial market and across from a generational perspective. But I think the key to the neobank success, and I think it's ironic that it's somewhat similar to how community banks are going to have to survive, is by really finding the niches in the market. Stessa Cohen, who used to work at Gartner, is kind of, I think, on her own now, published something this week or so, got me thinking. She was talking about tribes. And I think that's kind of key, is like identifying, who's your tribe? Who's the tribe that you're attracting and serving and understanding their specific needs? Because you're right, neither the neobanks nor midsize or smaller banks and credit unions can win the digital arms race, whatever you want to call it. They can't compete on trying to one-up the big banks on digital banking features and functions. They've got to do it through a product service delivery for very specific niches of the market. And I think that's going to be the same for a neobank. I've never been particularly bullish on Chime's long-term prospects because I don't really see that kind of differentiation in their product offering. And looking at the demographics of their user base, it's very low middle income consumers who I don't think are going to make great lending targets when they try to really figure out how to make some money in this. I also think, by the way, that many of them are totally out of the ballpark in their estimates, what they publicly say their customer base is or their account base is, because download is not a customer. So when they say they've got 6 million customers, 8 million customers, I have not been able to validate that or corroborate that in any research I've done.
Yeah. In building on tribes, I think one of the things that incumbents and the neobanks themselves have a problem with is digital is not a tribe. No one subscribes to the tribe of digital. It's something different. And digital is important, but let's put it in the right place, which is it is how I reach customers. It's how I interact. And it's most importantly, how I remove friction. And Mary, your comments around the onboarding, it made me think, ClickSwitch playing in that space. And disclosure, we partner with them at Alloy Labs that a number of our members have used them to accelerate the onboarding. But I just think to myself, what bank doesn't get why this is important? Like, they should just have an order form on their website where the bank has to enter their credit card number, because it's such a no-brainer that if you do not use digital to fix the onboarding experience, you are going to be a loser in this long-term arms race, right? Like, that isn't even an arms race anymore. Like, that's just keeping up. And when we rethink that value proposition around what is your tribe and how do you serve them, it also means we can't just be looking at what the other banks are doing and say, oh, I'm going to offer those same features, unless it's something like the ClickSwitch where it's smoothing onboarding. You need to think about what features and what tech goes into it that is unique to your tribe.
Well, I think that's right, because so much of what we have just talked about, and in my estimation, so much of the conversation across the industry is just about not losing. And I don't think we spend enough time thinking about, the bankers don't spend enough time thinking about how do we win. And it really is about, who those customers are. And Mary, you brought up there are those customers who like the branch, and that's fine for a certain number. That the question is that a growing market? Probably not.
You never know, JP.
I could be wrong. You two are the researchers, but I'm going to go out on a limb and say it's probably not. And what happens, when those people die off? I always joke the average age of most of the community banks is somewhere between age 67 and dead. And, the kids and the grandkids are not there. And that money flows out of there. And so, yep, we understand you got to be digital. You've got to have, the ability to retain the customers that you have. You need to have an ability to expand those customer relationships with other products and services, which is one of the challenges I kind of throw out about the neobanks, even though I'm all about the digital. And Ron, we've mentioned PFM a couple of times now. I feel like that's a little deja vu too. I mean, PFM was going to solve all this 10 years ago, right? We were going to have such rich data on our customers, and we were going to provide them with such amazing personalized advice. And customers, this was kind of like, we'll build the wall and Mexico will pay for it. We're going to build PFM and our customers are going to pay for it. Well, no, they didn't. And we never really even build up, in many cases, a lot of really important things, other than some pretty charts and graphs. I mean, is PFM really a part of a winning strategy?
Depends on how you define PFM, and I know where you're coming from with this, and I totally agree with you. Part of the challenge here is breaking away from sort of the traditional view of PFM as meaning budgeting, expense categorization, and backward-looking types of things.
Mm-hmm.
Information in and of itself is kind of, I know everybody thinks data is important, blah, 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 but from a PFM perspective, information in and of itself is kind of useless. It's generally too late for people. Nobody wants to, get it at 10 o'clock at night when they're sitting around watching TV. It's all about context, contextual, real time, in the moment type of thing. And it's really about action, not information. It's do it for me. Save me the money. Don't make me go into my stupid mobile banking app, look at a bunch of offers, choose them, and then remember, which ones I pay. It's like, just give me the deals, go do it for me, move the money. You found a better place for me to move the money? Just do it. Tell me after you did it, or, present it to me as an option to do it. So yes, I do think PFM is the answer to this, but not in the traditional sense of the word. It's not about information, it's about action.
Well, I think the other thing that we've spent a lot of time talking about the customer and the consumer, and I think in most cases we were thinking about individual consumers. Many bank customers are small businesses, and I think we are still in the very early stages of digitizing small business banking, not only on the lending side, but on the account opening side, on the same amounts of friction that we've talked about for consumers is many times more in many cases around the business. And I do think that the way that small and medium-sized financial institutions, community banks, credit unions that do like to tout their personal relationships, and I think we're all rightly kind of skeptical of that in as a vague platitude. But I do think there's a nugget of an opportunity there, and for many of them, it is around these small businesses. So I think there's opportunity to win there. I think there's clearly opportunity to use and to leverage technology to make things better. But I think that they've got to really understand more about what those customers' needs and what those customer pain points are. And, Jason, this won't shock you. It's something we spend a lot of time talking about. The banks just have to move a whole lot faster, right? And we all acknowledge that the way the technology stacks work make it not always so easy. But there's also a lot going on inside the bank around committees and layers of risk approval and all of that stuff. But I do think that the pandemic did make some banks move a little faster out of necessity on some things, and I think that needs to become a habit.
But habits are hard things to develop, and habits are even harder things to break, JP, right? And you talk about they need to figure out how to move. The other thing the banks need to figure out is they need to learn to move in different directions. This idea of I'm going to be a fast follower doesn't cut it. If, who are you following? Do they have exactly your competitive advantage and customer base and those things that, there are parts you move as a herd, which is the playing defense and that keeping up with the minimal feature set. But, back to Ron's tribe, we can't all have the same tribe. And so they need to start figuring out the moves they can make to establish their own tribe.
Well, I make a quick point, JP, on Jason's comment about being the fast follower. There's no bigger BS out there than a company saying we're fast followers. It's actually easier to be the innovator because you just do stuff and throw it out there and see what works. For you to be a fast follower means that you're actually tracking what's going on in the market, and you have a decision process that enables you to say, yes, this is when we pull the trigger. And when you do pull the trigger, you're able to jump in there and do that. That whole thing with all these banks saying we're fast followers, nothing says we don't know what we're talking about than somebody who says I'm a fast follower. And I can't wait to see all the email I'm going to get blasting me on that one. So,
well, Ron, that's one of our favorite topics. You and I have probably talked about this a dozen times, and half of those times on the show here. And I always say the operative word there is fast, right? You don't have to be out on the bleeding cutting edge, but reasonably fast. And what many bankers are really saying is we're a follower. And we're going to wait until all the risk has already been taken out of this because the old phrase that, the pioneers are the ones that take the arrows. And so how do we adopt something once we know that there's already no risk? And that was the part of, I think, my last little treatise there is that the banks really do have to move fast, and they don't have to be first, but they can't be, 987th because they've missed the opportunity by that point. So what else do banks need to do to win as we think about, again, leaning into the uncertainty? We don't know what the world looks like. On the other hand, when we open, but should we even open our branches? And some are open now, and some have not reopened. The number of branch closing has been increasing. Banks are looking for ways to cut out costs. Branch traffic has been down. I mean, some of that surely ought to get reinvested into some sort of digital capabilities. Where would you put your first dollars, Mary, if you were a bank leader today?
Oh, wow. I have to think about that, but I have one answer. I don't know if it's what I would put my money down first for.
Maybe it's your second dollar.
Maybe it's my second dollar.
Okay.
But something, as rates have been dropping, even the banks who compete on that are like touting other tools. So like Ally Bank, for example, has surprise savings, which is like a version of like a digit or something like that. I know Chase does that now. I believe Chase actually has aggregation, which was a big deal since they were vocal against it for a while.
Yeah, interesting move, right?
Very. The pendulum swings once again. But I think, Ron was talking about PFM, but I think one of the helpful areas is like crunching data that will help you before something will happen. Like I think your former US bank now warns people if they're about to to dip into overdraw their account before it happens. And I think Personetics is one of the company driving a lot of these things in the background. But I think that's promising. A lot of people, I mean, even though savings is high for some people, the other people are struggling immensely right now. So anything that could be beneficial for savings or just a lifeline, I would focus on that.
Ron, where are you investing if you've got a bank balance sheet at your disposal?
So I find that a really hard question to answer, JP, because I think it's so specific to every individual bank and credit union. For many banks, look, for better or worse, the problem is not on the consumer side right now. It was because they needed deposits. But reality right now for many community banks and mid-sized banks is that they've got a commercial loan portfolio that's, could be just devastated thanks to the death of real estate and their real estate loans. So, they've got to have to move, I think, more into, not just C&I lending, but, into specifically small business. For as bad as, it's going to look for small business, I think that's where the savior for them is in finding that. For the credit unions who are still very much retail focused, consumer focused, can't wait to get all the email I'm going to get on this one. But you really got to move the cost structure out of the physical branches. You've got to free up the expenses for digital, and it's credit unions have been for years loath to ever refire anybody. But the banks have no trouble cutting costs like that. The credit union's very different, but it's going to take a big cultural shift on the part of credit unions. You're going to have to cut a lot of expenses out of the branch channel and free up that investment for digital.
Well, and you talk about culture shift, it's really two things. One is, yes, our people are our greatest asset and we hang on to them. But the other thing is, yes, we'll cut the fat, but we don't want to cut the bone. If you consider your branch network as a part of your, core infrastructure, you're not going to cut that. If you're thinking differently, that it's one of the ways that customers or members like to engage with us, and we need to look harder at the ones that are really driving traffic and which ones aren't, you would deal with that differently.
But go back, JP, to my comments before. It's not about the physical space. It's about the access to the people. So They don't necessarily have to fire everyone or even a majority of people, but have to figure out who are really the key frontline people we need to keep and how to get them. Because, one person can interact with a wide geographic range of customers or members. They don't have to be in a physical branch. And obviously, of course, it's, you got leases and things like that you don't want to break, and you got legal obligations, but figuring out how to shift that investment from the physical to the digital is where the focus has to be, I think.
Well, and there is an intersection of that with deposits. You said, right now that's not a concern for a lot of banks. They're flush with deposits. That will change. There are cycles that happen. And over time, I think those that are positioned to gather and retain deposits digitally are certainly going to do better. But I also want to point out, I've heard a number of banks talk about, we talk about fast followers, a phrase people like, and so they repeat it without even understanding what it means. There's a similar one called flight to quality. That was true during the global financial crisis, that there really was a flight to quality because banks had liquidity and credit and viability issues, which may or may not appear at some point, depending on how this recessionary environment goes on. But just because money is sitting in your bank today doesn't mean that consumer has made a really positive choice of a flight to quality, and that it's going to retain forever. Because I still think you've got to fight to retain that customer, and at some point you've got to fight to, if you're going to grow, you need to be viable, you need to grow, and you need to pick up new customers along the way.
JP, you started us with talking about most have caught the Rubicon around digital transformation. I want to close with Rubicon, but the physical one, and lessons learned from the Rubicon Trail just north of Tahoe. One of my best friends, who's an auto writer, thought it'd be a good idea to take 3 of his best friends on straight off the dealer floor Jeeps and
Jeep Rubicons?
Yeah. Well, in fact, they were 2 right off the dealer floor, no mods, and 3 of the 4 of us, 0 off-road experience, right? And let's go 22 miles on, the Rubicon. But here's the lesson I think it's for banks is it's slow going. Like I could have walked the 22 miles faster at the start at least. But what you need to do to actually be successful in your off-road driving is you need to start moving and not stop. As soon as you've come to a complete stop, you're done. And you can overcome a lot of obstacles along the way as long as you're keeping, whether it be slow and steady progress, or the one of us who actually had a lot of experience was pretty fast over things. But the keep moving is what becomes the winner in any case. And I think whether you're an incumbent bank or credit union or one of the fintech startups, the idea is to go do something and to keep moving is one of the most important aspects of this. And the problem is right now, incumbents and innovators are both kind of looking at each other and recreating the same thing kind of in circles, not actually making forward progress. So Mary, Ron, thanks for joining us today. Hey, if you've enjoyed the Breaking Banks show, take a second to respond on @BreakingBanks1 on Twitter, recommend us to a friend, and make sure you subscribe wherever you get your podcasts. That's it for this week's Breaking Banks.
Great. Whether you're Julius Caesar crossing into Gaul or a banker trying to have a digital bank account, you got to cross the Rubicon. All right, everybody. When I hit end, it'll disconnect all of us. So, but thanks. This was a good discussion. Enjoy.
Thanks, guys.
Enjoy the lake,
Hey,
Mary. Are you flying Delta?
I am flying Delta. So
You can be thankful for that.
I hope so.
Safe travels.
Thank you.
Bye.
Bye, guys.
See you.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.